Thank you, Dottie. First of all, I'd like to congratulate each and every one of you for being here this afternoon. It's a gorgeous spring afternoon, and here you are learning about Social Security and optimization strategies. So thank you for coming. Hope you will enjoy the class and get a lot out of it. Sean was mentioning that, boy, you've got a lot of material to cover in a short amount of time. So get those pens out and we'll see if we can't get started. So what do you need to know before you start your benefits? Well, a lot of folks say, Allie, there's really only 3 things to know, isn't there? Am I going to start it at 62, which is the earliest time? Am I going to wait till my full retirement? Or am I going to delay and wait till age 70? 3 things to know. Well, guess what? There are over 567 combinations of things to know and strategies that will determine when you might want to take your Social Security benefits. And did you know that the Social Security handbook is over 2,700 pages long? So I think an hour and a half on a sunny spring afternoon probably beats 2,700 pages of reading. How about you? So our goal as a 501c3 organization, and that stands for American Financial Education Alliance, is to help the communities across the United States be empowered with financial education. Now, as mentioned, my background, I've been in this 35 years, which means I've seen a lot of changes in government, in Social Security, in taxes, a number of different areas. There are a number of AFEA members that are here with us this afternoon, and as Dottie mentioned, we're here for you. This is your afternoon. If you have questions, if you have things that you would like to talk to us about, we will be present out in the atrium afterwards, and we also will do individual strategy sessions with each person that's interested in that. If you would like to have the time to say, well, you know, those 567 combinations, I have a special one that's just me, or just me and my spouse. So we have a lot of background in this. We are planners, we are wealth managers, but today my role as your instructor and coach is as a representative of our AFEA chapter here in Knoxville. We've already talked about where the restrooms are located. If you're like me, you might need to remember to silence your cell phones. In fact, I hope mine's silenced over here. We are going to cover everything in a general nature, so if you have specific questions, hold those for the atrium or for your own strategy session. And we are going to keep this moving quite rapidly. Again, what's our mission? Is to inform and empower Americans to take control of their finances by providing comprehensive financial education in communities nationwide. Many people say, well, you know, how are you funded? Well, we are, for the most part, funded through donations. So we have membership dues, we do advanced courses in colleges and universities, chapter sponsorships, and if you're interested, you are going to be emailed a link to download the workbook, and at the back of the workbook is actually information more about how you could take part in this educational opportunity. If you will, write down this number, 4618. By coming to our program this afternoon, you have the opportunity to become a student member of AFEA. There's no charge, and what you'll really enjoy about this organization is that if you can't sleep at night, 2 o'clock in the morning, you say, let me see that mortgage calculator again, or gosh, I need to review what we went over about Social Security. They have opportunities at AFEA for you to get this type of education, no commercials, nobody to bother you or worry you. So that is the chapter ID, and you have an opportunity on your course evaluation. We're so thankful AFEA asked us to come speak. Actually, one of their management team attended one of our workshops and said, wow, I think this is information that AFEA should pass on to the community, and as a result, here we are today. So everybody has a course evaluation. If you would like to receive the link for the student membership, it's right in the middle, there's a little box. If you would like a strategy session, and you probably can't determine that now, we haven't gotten started, but as we go, there's an opportunity for you to check that box as well. So take down that number, 4618. And now you get to see that Allie Swafford can read. For 501c3 purposes, they require that I read this disclosure to you. AFEA, the American Financial Education Alliance, is recognized by the IRS as a 501c3 nonprofit charitable organization that provides educational workshops and classes in businesses and universities nationwide. Our instructors are licensed and trained financial professionals with a minimum of 5 years of real-world experience in their field. They have been required to pass a series of training sessions on how to properly educate in a not-for-profit setting before becoming a personal financial coach and instructor with AFEA. AFEA courses and workshops do not promote or endorse any specific products or companies, and no selling is allowed. AFEA educational workshops and courses are for general education only and are not intended to be construed as investment, tax, legal, or financial advice. Attendees should seek the assistance of a professional familiar with the course prior to implementing any of the ideas and strategies taught or discussed in the course. Hypothetical and/or actual historical returns contained in this presentation are for informational purposes only and are not intended to be an offer, solicitation, or recommendation. Rates of return are not guaranteed and are for illustrative purposes only. Projected rates do not reflect the actual or expected performance within any example or financial product. Past performance does not guarantee future results. The presentation is not intended to be legal or tax advice. The presenter can provide information, but not advice related to Social Security benefits. Clients should seek guidance from the Social Security Administration regarding their particular situation. The presenter may be able to identify potential retirement income gaps and may introduce insurance products such as an annuity as a potential solution. Social Security benefit payout rates can and will change at the sole discretion of the Social Security Administration. For more information, please direct yourself to the local Social Security Administration office or visit www.ssa.gov. All right, pretty good reading, don't you think? Okay, the next little fella coming up, now I'm Allie, A-L-I, this is Owlie. And when you get your workbooks, again, don't forget to download them after this presentation. This little guy is going to pop up throughout your book when there's a point that's of particular interest or something that you should note. So he's kind of fun, and he'll be with us throughout the afternoon. So the big question is, what is Social Security to the average earner? Well, the answer is it's intended to be about 40% of your retirement income. So I like to think of it this way. If you looked at your paycheck today, and let's say you were bringing home $50,000, and 40% of that then would be $20,000. So just think, if somebody said to you, could you live without 40% of your paycheck, or $20,000? Well, the answer would probably be, no, that's not within my budget. Well, the other flip side of that is, where does that other 60% come from? Now, for higher wage earners, that Social Security number of 40% is probably high, might be closer to 30%. For lower wage earners, that 40% might be low, it might be a little bit more. But the objective or the idea behind this is that nothing stands on its own leg. Social Security doesn't stand on its own leg, a pension won't stand on its own leg, 401k or investments, they all work together. And that's the purpose of us trying to learn more about how that Social Security piece fits in with all the pieces of your financial plan. So, how complex is Social Security? I began the program by saying 567 different sets of calculations are needed with just our everyday solutions. There are 81 age combinations. And again, what we're trying to figure out is what works best for your particular situation. I don't think any of us want to leave over $100,000 of potential benefits on the table. But could I say that what's right for you is right for you is right for you? Absolutely not. And that's why we need to learn what are the options. So, will Social Security be there? This is a question a lot of folks have said, you know, I don't know. Back in 2009, when you got your paper statements, and now most of you will say, I don't get a paper statement anymore. I actually get my information online. Some of you still get a paper statement, but in 2009, it was projected that in 2017, we would be paying out more to recipients of Social Security than we were taking in, and that the trust fund would be exhausted by 2041. So there were issues in Social Security that were recognized back in 2009. Well, let's look at the math just 1 year later. So here we are in 2010. Well, you remember 2009 said by 2017 we won't be bringing in enough money. 2010, now it's down to 2016. And look at the number. The trust fund, instead of 2041, now 2037. And you'll see now that Social Security was predicting that without some changes in the current way that it's administered, taxed, that we would only have about 76 cents on the dollar. So again, as we're planning and looking at how Social Security integrates with our other assets, we need to keep this in mind. Well, in 2014, we're now down to 2033, but we did gain a penny. Now instead of 76 cents, we're projecting 77 cents. But what this is saying for future generations, and there are some of you that are those future generations, we really need to do some planning. Now, for any of you that are in the baby boom generation, close to Social Security retirement age, probably not a lot of changes that you're going to see, but there's a lot of proposals out there. One would be to tax all wages. Right now there's a cutoff when they stop withholding payroll taxes for Social Security. Maybe they're going to tax every dollar. Another one might be, instead of being able to start Social Security at 62 and full retirement age being between 66 and 67, maybe the early retirement would move up to 65 or 66 or 67. And right now the latest that you should turn on your Social Security is age 70. Maybe that's going to move up to 72. There's a number of different proposals out there. But again, this is one of those things where you have worked your entire career contributing to the system. So we want to make sure that you can maximize your benefits, and hopefully that these benefits are going to be around for future generations. Now, we have a pretty little lady that's coming on the screen. Does anybody recognize this lady? Well, she could have been one of our grandmothers, right? This is Ida Mae Fuller. Ida Mae Fuller. I'm seeing a nod back there. This pretty little lady was a legal secretary up in Vermont. And she was actually the first recipient of Social Security. She contributed for 3 years into Social Security, and by that time she had contributed $24.75 to the system. Well, at full retirement age, which back then was actually 65, you can see that's already changed, she began receiving a check of $22 and I think it's about 68 cents. And between that time until she was age 100, they had paid out $22,888. And how much did she put in? $24.75. So you can see that when FDR introduced this program, it was never meant to be for everyone and for 25 or 30 years. It was really old age and disability, and only the fortunate few who lived past 65. Because you know what life expectancy was when FDR introduced the program? 63. So you can see, never intended to be for all of us, because I think we would all agree today, hey, 65 is the new 45, 50. We have the opportunity through medicine, through better health, through better nutrition. We may be around as long in retirement as we were in our working careers. And so again, will it be enough? Back to what other income sources will you have? Yes, you've worked hard and contributed to the Social Security system, but it's not going to be able to stand alone. So what other sources of guaranteed income might you have? Anybody in here have a pension? Any pensions? Look at these lucky few, and then you can see by the number of hands, it is a few. We're seeing more and more personal responsibility through programs like 401ks, IRAs, 457 programs. So we need to look at what do you have that's guaranteed that's coming in. If Social Security was only supposed to be about 40% of your retirement income, and if in retirement you're going to need 80 to 100% of what your exiting income was, then you can see that, like Ida Mae, we better have something else to supplement that Social Security. So what do most retirees have on their mind? Well, their number one question is, will I outlive my money? I've been fortunate enough to be able to talk to people who are preparing for retirement for quite some time. I used to fly back and forth between here and Florida. I'd go down and all the snowbirds would be there and we'd talk about retirement and they'd all be in pink and white, Easter time colors, right? But then they would say, oh, what if I die too soon? Well, now the question is, uh-oh, what if I live too long? 54% of Americans are worried about not being able to maintain their current standard of living. And I think that's probably an objective for all of us. We certainly don't want to work our whole lives and then have to change, cut back on our standard of living. So the question Owlie's popping up here with is how much money do you really have, and where does that come from? How many of you do have a 401k, an IRA, a 457, some type of plan? Okay, almost every hand went up. And tell me about that. Was it a pre-tax contribution? Did they withhold that from your check before you received it? Probably the answer is yes. Well, if that's the case, and many people have a number, this is my number, and let's say your number is $1 million. If I had $1 million when I got ready to retire, then I think I could live comfortably. Well, if that $1 million is in a 401k plan, just like Owlie's asking, do you really have $1 million? No. Guess who's your partner in that $1 million? Uncle, but his name's Sam, because there will be taxes taken out. So one of the important things when you think about, am I going to outlive my money, is really what is that net amount that you have to fund your retirement. We have to take taxes into consideration. So things like Roth IRAs, I see some young faces out here, and boy, if there was one thing I could say to you folks or to some of our children or grandchildren, it was check out that Roth IRA. What a wonderful opportunity where you can either contribute to the Roth, have it grow tax deferred, then come out tax free, or if you have a lot of money that's in a 401k or an IRA, possibly some planning where we could move some of that money from that pre-tax, where you have Uncle Sam as your partner, into after tax, where it would grow, come out tax-free, and what a great asset to pass on to the next generation if you don't need it. Well, these are some of the things that you need to be contemplating when you're thinking about when and how much will my Social Security be. So here we've got a little Pickles cartoon that says, "What's the matter, Earl? You look a little down." Well, according to statistics, I have a better than 50% chance of living to the age of 87. Well, what's wrong with that? I can't afford to live that long. So we don't want you to be stuck in a Pickles cartoon. So the big question is, when should you start taking your Social Security benefits? Well, did you know that over half of all Americans take their Social Security benefit at the earliest moment possible? The earliest moment possible. Well, I come from a sports background as well, and so what I call that is, oops, you just got a penalty. You're in the penalty phase because you took your benefits early. Well, what about those folks who wait and go longer without turning on their Social Security benefits? I call that the bonus phase, because again, you could get as much as 132% of your full retirement age benefit by waiting until age 70. But is there a right or a wrong answer to when you should take your Social Security? Again, every person's situation is different, and that's why we do offer that individual strategy session. Through AFEA, you can just come and talk about your situation, because this is really what it boils down to. We have two horses. On one side, we have your assets. Certainly, if you are going to delay taking your Social Security benefits, that means you're going to have to use some of those assets, that other 60%, because you still have a need for your income level. Approximately 80 to 100% of your pre-tax, pre-retirement benefit. But what about Social Security? Well, the other side of that is maybe I need to take Social Security and let my assets continue to grow or defer. Now, what would be some of the reasons that you would choose one or the other? Well, the first thing would be health. If you have a health issue and you know that your life expectancy is relatively short, well, then the answer would be at 62, which is the earliest age you can apply for Social Security benefits, go apply, because you don't have that longevity. When we say that, and our software will default and say, men, you might live to 83, 84 years old. Women, you might live till 87, and that's just an average. Well, if you know your life expectancy is 70, 72 because of health issues, turn your Social Security on at 62. The other thing to turn on Social Security would be if you are struggling financially. Well, there's no use for you to struggle 4 more years or 5 more years, depending upon when your full retirement age is. Go ahead and turn that Social Security on. But on the other hand, we have many clients that will tell us, you know, I get my Social Security check and I just kind of put it in the bank. It's not something because of my assets that I really need. Well, then there's a really good reason to say, well, for sure, don't turn on your Social Security till full retirement age, and you might even be someone that you'd say delay till 70. Now, my dad lived till 92, and he had a much harder life than I do, and I have much better access to good medical facilities and doctors. I hopefully maintain a healthy lifestyle. So for me, I'd say, ooh, I've got longevity on my side. Ooh, I've got some assets, both qualified, that I know Uncle Sam's my partner, but also non-qualified. So in my planning, the integration of both of those, for me, I'd probably say, I'm going to delay. But again, is there a right or wrong answer? No. But if you are a spouse, if you have a spouse, there are some real reasons for you to look at an individual strategy session, because what one spouse does affects the other spouse. And so there may be some hybrid strategies within all of those 567 combinations that would be important for your particular situation to look at. So the bottom line to this is there's not a right or wrong answer. It's dependent upon your personal situation, both from a longevity standpoint, a financial standpoint, what your other assets are, what your spouse or partner's Social Security benefits might be. And all of these can be answered, and we can look at them for you. So what are the pieces of Social Security benefits that really make up this puzzle? Well, the first one is you've got to determine, what is my Social Security benefit going to be? The second one is, well, now I know what it's going to be, but what options do I have around that? And the third part of that is maximizing your lifetime benefit. So let's talk about your Social Security statement, which, as I mentioned, many of you at this point may be getting online rather than by paper. But again, it's going to summarize your earnings that were subject to payroll taxes. Now, You might say, well, aren't all earnings subject to payroll taxes? Well, let's say you had a job overseas. Well, they didn't take out any payroll taxes while you were overseas. So in those years, you got a big zero on your Social Security statement. Some of you may have worked for a government organization, and they may not, because you had a government pension, taken out anything for Social Security taxes. So that too would show up. Some of you may have a hybrid situation. Some years I had payroll taxes taken out, other years I didn't. So what are they going to show you? They're going to show you how much you've paid in and your employer has paid in, and then they're going to give you estimates of the different retirement benefits. Up in the right-hand corner, if you have a paper report, it's actually going to give you a number, and it's your full retirement age estimated benefit. You have to open up the statement and look inside to see what it might be projecting for age 62, and then it will also project for your full retirement age. And again, Owlie's going to pop up here and say, there are a lot of acronyms. Your primary insurance amount, PIA, is going to be the highest average of your 35 years of employment. Now, many of you may say, well, you know, I took a few years off. I had my family. I have some zeros there. Others of you may say, gosh, I've already worked 42 years. Well, they're going to take the average of the highest 35. If you don't have 35 years of a work history, they're going to put zeros in. So if you work 25 and you have 10 zeros, they're still going to average all of that together. Now they will go back, because we all know if you were making $15,000 in 1970, that's a lot different than making $15,000 in 2019. So there are some adjustments in there, but the bottom line is your highest 35 years, zeros averaged in if you don't have the 35 years. Another point that we often want to make is, remember, Social Security in these reports is assuming that you're going to work till full retirement age. Now, for some of you, that may be age 66. Some of you, it may be 66 in some months. And for the younger of you in the audience, it's going to be age 67 at this point. So the assumption is, when you see that number, is what did you earn? Look at that last year that's recorded. They'll show you how much was taken out in payroll taxes by you and your employer, and based upon what number. And remember, right now they only tax up to a certain limitation. So if you're a very high wage earner, they didn't take payroll taxes off of the end of the year, your very high wages. But again, 35 years. So okay, we've now figured out what's going to determine our primary insurance amount. Well, here are some terms that we need to become familiar with. And we're going to go through each one of these one at a time. Alrighty. So the first one that's up there is eligible versus entitled. So let's talk about that. An eligible worker is one that has accumulated the number of credits for work to qualify for Social Security benefits. And generally that's 40 quarters. 40 quarters would be 10 years. So if you personally have worked for 40 quarters, 10 years, then you are an eligible worker, which means you have your own work record. Now, there's another term that's real close to that, and that's entitled, but they're a lot different. An entitled worker is one who's actually applied for benefits, whether or not they are receiving the benefits or they have suspended them. And you'd say, oh, that's kind of confusing. Well, this is going to become more apparent as we talk about this whole entitled worker. And we're going to ask you all, there's going to be some of you, I call you the lottery winners in the audience. If you are not taking Social Security and your birthday is prior to 2/1 of 1954. So how many lottery winners do I have in the audience today? 1, 2, 3. Oh, come on. 54 is a good year. Anybody before that? We do have some folks. As you all may know, Social Security had a change and a modification that took place in 2015. They phased out some of the opportunities of planning that we had with all you folks. But for people born on or before 1/2 of 1954, there are still some of these benefits where you can restrict, suspend some opportunities for you there. So, deemed filing. Well, deemed filing requires that a claimant filing for any benefit before full retirement age is deemed or must file for all benefits available to them. Now, what does that mean? We talked about PIA, so that's that 40 quarters, the 10 years. So you have a Social Security amount based upon you were eligible. Once you reach age 62, then you can do that. So you could apply. So if you file before full retirement age, so if you filed at 62 or 64, even 65 at this point, because right now the earliest full retirement age for folks who are not claiming is 66. So what they're saying is if you're eligible on your record and you're also eligible because you are a spouse, is Social Security is going to look at everything you're eligible for, and you are deemed to have filed for the benefit. They're going to give you the higher of whichever benefit you're eligible for. Does that make sense? Okay. Alrighty. That one gets a little confusing. So these two are actually for folks who, if you have worked for federal, state, or local government, this windfall elimination provision. In other words, if you have worked where they have not taken out payroll taxes out of your check, then you are going to be operating under this WEP, or windfall elimination provision. And we have had folks come to our classes where they have mixed records. They've worked for a government, they didn't have any payroll taxes withheld, they now went into private sector, had payroll taxes withheld. Gets a little bit more confusing. And government pension offset. So the spouse or widow or widower's benefits, if you receive a pension from a federal, state, or local government and did not pay Social Security taxes, it will also affect that benefit as well. So these are two that are kind of specific for a situation. But what about claiming age? We've talked about it a couple of times. The earliest is 62. The full retirement age for people born between 1943 and 1959 is 66. But know that between 55 and 59, it's not 66 on the button. It starts out with 66 in 2 months, 66 in 4 months, 66 in 6 months. You get the idea. But if you were born in 1960 or later, right now, the full retirement age is 67. Now, the latest, and I've talked about, remember the penalty phase? That's between 62 and your full retirement age, and the bonus years between your full retirement age and 70, I get a lot of people say, well, hey, let me just keep putting into that system. It'll get bigger and bigger and bigger. Doesn't happen. Doesn't happen. 70 is when you need to apply for your benefits. Now, that doesn't mean you have to stop working at 70. Doesn't mean that it might have some adjustment to it, but it's when you stop getting those delayed credits. And remember we talked, if your full retirement age is 66 and you wait till 70, 8% a year, 4 times 8, 32% higher benefit. But what I'm telling you is you're not going to get another 8% if you delayed from 70 to 71. 70 is the time you need to apply for those benefits. Now, a lot of people say, and I use this example a lot, one of my clients was a minister, and he had a nice income, but not a huge income, and he was about to turn 62. So he said, Allie, I think what I'm going to do is I'm going to go down and apply for my Social Security benefits. And I said to him, well, do you think you'll continue to pastor at your church? And he said, absolutely. I just would like to supplement my income. Well, I said, do you make more than $17,640? And he said, I sure do. And I said, well, you're going to run into a little bit of a problem if you have budgeted to have your full pastoral salary plus your full Social Security. And what's the problem? Well, it's over here. If you make more than $17,640 in 2019 and you are below full retirement age, for every $2 over that limitation, Social Security is going to withhold $1 from your benefits. So what is that saying to us? Ooh, if we have an income that's higher than $17,640 and we were anticipating we were going to get dollar per dollar of our Social Security money if we applied early, that won't be the case. They'll withhold it. Now, when you turn your full retirement age, they will recalculate the benefit. So it's not just totally lost, but it's certainly lost for those years between the time you turned it on early and the time that you reach full retirement age. Well, what about the year in which you reach full retirement age? Is anybody here born in the month of January? Here's some more lottery winners. Okay. In the month when you reach your full retirement age, and we're going to assume that it's an even number, it's 66, and I realize some of you may be 66 in 2 months, 4 months, whatever it is, but let's say your full retirement age is 66. Well, what they're telling you is between January 1st and whatever day, we got 3 January birthdays. 22nd. 25th?
No, the 5th.
The 5th. Oh boy, you can make a lot of money in 4 days. What they're saying is, before you reach your full retirement age, assuming it was that even number of 66, you can make $46,920 in those 3 days, because remember, we had a holiday, and not have any reduction. But my birthday's in November and the end of November. So for me, if I were a higher wage earner, I could only earn up to $46,920 by my end of November birthday, or they would be withholding $1 for every $3 over that limit. But again, you're about full retirement age, they're going to recalculate it. Probably not a major issue, but just something to be aware of. And here's the big one that a lot of folks who come to these classes don't realize, is that after you've reached your full requirement age, there is no limitation on earnings. So that is when, if you want to, you feel good, I love my job, I want to stay doing what I'm doing, well, shoot, Social Security doesn't care. You could earn $1 million after full retirement age and still get your full retirement benefit. But now remember, if you were earning that $1 million, there might be a good reason to wait. Remember that 8% per year that automatically is being added, that deferral bonus. So these are just some of the nuances of how working could impact your Social Security benefits. So here's Owly popping up again, basically saying, for those of you whose birthday is January the 4th or 5th, pretty good time. You can make a lot of money that year. So, provisional income. Now we're kind of shifting gears. People say, now, wait a minute. Wasn't this Social Security benefit built upon what was withheld from payroll taxes to get there? Now you're going to tell me we have to come up with a calculation of how my Social Security benefit is going to be taxed? Does that sound a little bit like double taxation? Yeah. It's the American way. Tax you in, tax you out. And this is how we figure out this calculation. So provisional income, the first thing to realize is that it's the sum of all your income, even tax-free municipal bond interest, plus half, not all your Social Security benefit, but what's projected to be your Social Security benefit, cut that in half. Add that to all your other sources of income, which might be wages, distributions from your 401k, interest, dividends, capital gains, even the taxable portion of inheritance. And people go, what do you mean the taxable portion? Remember when we talked about Ross being good money? You could pass that on to the next generation. It was after tax, grew tax deferred, next generation gets it. They still have to take it out over life expectancy, but it's coming out tax-free. Well, if you have an IRA, a 401k, and it passes on to the next generation, not your spouse, that's a rollover, and that's fine, but to the next generation, then that pre-tax money that Uncle Sam's a partner with, guess what? Uncle Sam's still the partner. And so you might receive an IRA as part of your inheritance and owe income tax on that IRA. And that would be counted as part of that provisional income calculation. You might have sold a business. In comes your business income. That might be part of that provisional income. So remember, this is how taxes are calculated. And although Social Security has changed many things, I mentioned to you it changed in 2015, started out that you could receive your benefits at 65. It's now for people born 60 or later at age 67. This particular taxation chart has not changed since the mid-80s. Now, what does that mean to you? And basically what it means is, are you going to pay taxes on your Social Security benefits? If we look at half the Social Security and all those other sources of income, and you are a single person, and that total is $25,000 or less, then no, you're not going to pay taxes on your Social Security. If you're a married couple, that number is $32,000. But then look at, let's say you are a married couple, and we're going to give you a little example here. And let's say that you needed $40,000 as a married couple to maintain your standard of living. Well, you'll see over here to Allie's side that 32 to 44 for a married couple is taxed at up to 50%. Now that doesn't mean it's a 50% tax. It means that 50% is going to be in your tax bracket. So half your Social Security could be taxed in your tax bracket. The line below, over $44,000, up to 85% of your Social Security will be taxed in your current tax bracket. Well, this is why we say Social Security planning and just retirement planning is very much a couple's opportunity, because let's say, unless you're killed in a common accident, one of you is going to predecease the other. So let's take that same $40,000 to maintain your standard of living. Well, if you are a married couple, up to 50% of your benefits would be taxed. But if you still needed that same $40,000, look over on the single filing side. What happens there? Up to 85% is taxed. So what we often say is, what happens when one of two spouses passes away, you're going to lose one Social Security benefit if you were both receiving benefits. So that means the lower benefit, no matter if it's your benefit or your spouse's, whichever one is lower, is going to go away. So we have one Social Security benefit. But now what happened? Still need that $40,000. You're still getting that $40,000 with the provisional income calculation. What happened? Taxes went up from 50% to 85%. So income went down, taxes went up. So the decision that each one of you make is not just a decision for you. It's a decision that should take into consideration your family situation. How can I maximize with not only Social Security, but with my retirement planning to make sure that I'm well taken care of and my spouse is well taken care of as well. So, what are we going to come up with next? Well, we're going to talk about some of these benefits. Normally at this time we take a short break, but because, as we mentioned, we're on kind of a tight time frame, you will not offend me if you need to take that break, and I believe the break was to the left outside of the room. But we're going to come right on and keep going here. Also, when you finish this session today, we had mentioned to you that there is a course evaluation sheet. This is your time to grade me, to say, hey, I got something out of that, or this improved. That's what this sheet is about. You'll also notice at the bottom of this sheet, it says other organizations or businesses and who a contact person might be. If you feel this type of information would be valuable to your organization or your church or your civic group, that's how we got here. Again, we had a workshop at a library. One of the AFEA management folks came and said, hey, I think this is something that would be a good educational event for the community. So please write that down, and don't forget to check the box in the middle if you would like to get the link for the student dashboard, and if you would like to have that personal strategy session. On the back of that sheet are a number of different times that are available for you to have a one-on-one, no cost, no obligation. Let me talk to you about my Social Security situation or how I might maximize the benefits for me. So it's on the back of this sheet. Normally at the break, Jenny, who's standing at the back of the room, Lynn, who's outside, would help you in scheduling. we're going to need to do this at the back end of the class today. So if you would like that strategy session, you can do that right on this sheet. You can also schedule online, and if you want to write that down so that you can schedule, you can do that as well. So either way, yep, I know nowadays just take a picture of the screen. It's the easiest way to get that. But again, we can help you with your individual sessions. So let's keep moving. Spousal benefits. All right. Well, the first thing is that there are individual benefits. Remember that 40 quarters or 10 years to determine if you are eligible. And eligibility, again, is at age 62. So you might say, all right, I'm going to collect on my own benefit. So that would be my individual benefit. Each spouse could collect on their own work record. The second opportunity might be the lower earning spouse can collect up to 50% of the higher earner's full benefit. Now I want to stop right here for a minute, because what I've noticed is there's often some misunderstanding. Remember my penalty phase, below full retirement, my bonus phase, after full retirement age? See where that says 50% of the higher earner's full benefit, which that means if one spouse continues to delay, most conceivably the higher earning spouse, the spousal benefit for their partner will be based off of that age 66 or 66 and 2 months or 67 if that's full retirement age, not off of age 70. And a lot of people say, ooh, the spousal benefit is going to go up that 8% just like the person who gets the delayed credit. It's full retirement age benefit. And then the last option under these benefits would be as a survivor. So a widowed spouse can collect up to 100% of the deceased spouse's benefit. And we're going to talk a little bit more about some of these opportunities or things that you need to be aware of when it comes to these different benefits. So to claim a spousal benefit, you must be at least 62 years old or have a qualifying child in your care and have been married for at least 1 year. And again, a qualifying child is a child under age 16 who receives Social Security disability benefits. If you elect to receive a spousal benefit before you reach your full retirement age, remember that gap between 62 and 66 to 67, your spousal benefit will be permanently reduced. No more of the added credits. You will get a cost of living, COLA, but COLA will be the only way that that benefit will increase. Again, unless you have a qualifying dependent child. If you claim a spousal benefit before you reach full retirement age, you will not be able to switch to your own retirement benefit at a later date. So this is a really important decision. We don't want people making these early decisions or one record versus another record without really thinking through it. And it is not just a 1, 2, 3 decision. This one is a little complicated, and I'm going to try and walk you through it. If you start your own regular benefit, which you could, you're claiming on your record, and then you switch to a spousal benefit when you reach full retirement age, you will not receive the full spousal amount. Because what did Social Security anticipate that you were going to do? They said, well, you were going to work till your full retirement age. We'll use 66. You were going to work to 66. Well, you chose to take your benefit earlier, maybe 62, 63. And remember, had you worked till your full retirement age, assuming it's 66, and your spouse had worked to his or her full retirement age, assuming 66, then your spousal benefit would be 50%. But you took your benefit early, and so now when you get to full retirement age, you're only going to be able to add the spousal excess. So it means you won't get quite 50% of the higher spouse's benefit. A little complicated, but just keep that in mind. If you take it early, there's a penalty for that, even if you're planning to switch to spousal benefits. In the event of divorce, you may be entitled to Social Security benefits if you're at least 62 and you were married for 10 continuous years. Now, some of you may be too young for Johnny Carson, but I'm sure there's most all the audience at least has heard of Johnny Carson. Anybody heard Johnny Carson? All right, good job. What is one thing Johnny Carson was known for? He got married a lot. But guess what? He stayed married to those ladies for a period of time. Actually, Johnny Carson had 4 women, all being able to claim benefits because they had been married to him for 10 continuous years before they got divorced. And guess what? If there's a 5th Mrs. Johnny Carson, doesn't affect her benefit at all. Now you can see why Social Security might have some problems in paying out all these people. So what's the moral of the story? Stay married to that one person. But again, if you are in that divorce situation, you must be 62, you must have been married for 10 consecutive years, and you must be unmarried, and your ex-spouse must be entitled. Now, do you all remember what entitled was? Entitled was somebody that was 62 or older. Well, you might know that not all divorces are just on the best of terms. So sometimes what happened was the entitled spouse who had the big work record said, well, I am just not going to file for my benefits, so my ex is not going to get divorced spousal benefits. Well, they had to change that rule. So now you'll see that you can become independently entitled. So without your spouse becoming entitled, as long as he or she is 62 years or older, and the divorce has been final for at least 2 years, and your own benefits are less than 50% of your ex's primary insurance amount, then he or she doesn't even have to know that you have filed for those benefits. And if there is a current spouse, it will not affect his or her benefits based upon being married to your ex-spouse. So this was a change, and I think a change for the better within Social Security. They recognize just a factor in American life. So in 2015, as I mentioned, there were several things that changed. Back to our lottery winners, and I think we had about 3. The restricted application, you folks have an opportunity that the rest of the folks in the audience who are born after 1/2 of 54 or who are have already filed for their benefits. So when you have a strategy session, talk to us about this restricted application. What about survivor benefits? If you are a widow or widower, you're eligible to collect either your own benefit or 100% of the deceased spouse's benefit, whichever is greater. In this case, you need to wait till you are 60, and your benefit will be reduced if you take it at 60, but you are eligible. The assumption is, again, that you would not take the benefit till full retirement age. You must have been married for at least 9 months, or if you were divorced and now your ex-spouse passed away, you must have been married for 10 years. And you must remain unmarried until after the age of 60. So this is how you would collect for a survivor benefit. Here is Owly bringing up again the highlights of what changed through the Bipartisan Budget Act. Remember, widows or widowers can still restrict to only the widow or retirement benefits and later switch to another benefit that they're eligible for. So that one is important and may come up for some of you if you are a survivor. So how do we maximize lifetime and survivor benefits? Well, one of the problems we have, and I would call this, ladies, a problem for women a little bit more than men. And the reason is that in this study, and this is 2010, we had 82.8% of the 53,364 folks who turned 100, they were women. So that's saying women, for the most part, live longer than men. And that can be 5 to 10 years longer. And so the decision about how to take our Social Security benefits is extremely important. It's also extremely important to look at those other assets. And the longer we live, the more important things like sequence of returns. And that means, what happens? Is the market going up? We've certainly seen about the last 10 years, longest period in history, of a continuous up. But what happens if we, instead of having 10 continuous ups, had 10 continuous downs? Well, if we were only going to live, let's say 10 years, we took our benefits at 62 and we're gone by 72, well then the amount we withdrew per year is not really that relevant. You could take out as much as 10%, but taking out a safe, and there's a rule of thumb, and the rule of thumb doesn't work in all situations, but if you're anticipating taking out more than approximately 4% of that other pool of money on an annual basis, the likelihood of you running out of money before you run out of life, and women particularly for you, is quite large. So this is really an important factor, again, of how do your assets and your Social Security integrate with each other. So as I mentioned, this study's a little bit old, and our software today says that, guess what? Women, probably around 87. Men, about 84. And if you've made it to 65, there is a really good chance, 25% or more, that one of the spouses is going to live to 97. So how long will you live? We talked about this, looking at family history, looking at your own health history, talking about those things like sequence of returns and rate of withdrawal, types of assets. What do you have that's guaranteed? beyond Social Security. So we're going to talk about a case study that will have some relevance to a few of you, and again, due to the 2015 Bipartisan Act, will not affect a good deal of you. But here's how, with planning, remember those 567 combinations? Well, you can look at Joe and Cindy. They're both the same age. Now that's important in this factor because we're saying when Joe turns 62, so does Cindy. So when Joe turns 66, so does Cindy. So you can see the difference in the benefits. If they took their benefits early, both at 62, Joe would get $1,675. Cindy, $681. But let's go over to age 66, because remember, for them, 66 is full retirement age. Well, you might say, okay, well, if Joe turns on his benefit, he'd get $2,416. Cindy's is the lower benefit, $982. Well, why don't we, here would be one scenario, say, hey, Joe, look at that number. If you wait till you're 70, your benefit goes from $2,416 up to $3,434. But Cindy, why don't you take your benefit? Well, guess what? Cindy's benefit would be that $1,204, because remember, it's off of half. So go up there to Joe's age 66 and see that her spousal benefit would be half of that age 66 benefit. But for these folks, they have an opportunity. And again, there are very few of you that fell into the lottery winner's jackpot. But in this case, Cindy could actually apply for her benefit at 66, get her $982. Joe could restrict his application to spousal benefits on Cindy's benefit. They now would be getting over $1,400, which is greater than if Cindy had just taken the spousal benefit. But then by delaying until they got to 70, Joe can switch to his own record, $3,434, and Cindy can get the excess between her $982 and the $1,208. So this combination allows them not only the $1,392.49, but can move up the amount of benefits that they would reach to $1,545,026. So you can see strategies within the opportunities that are out there can make well over $100,000 difference in total benefits. So, do we have any golfers? Any golfers out here? 1, 2, they're ringers. All right. Anybody know when you hit a bad shot in golf, there's something called a do-over. What's that name? Mulligan. You got it. All right. Well, Social Security has a mulligan, a do-over strategy. You only get to do it once in your lifetime, and it must be within the first year of you claiming your benefits. And what does that mean? Well, I've heard far too many people. Remember, I've been doing this 35 years, and I've heard now mostly it's women saying this. I'm sure there's a few men, but hey, I've got twice as much husband and half as much income. Have you ever heard that? So what are we saying? All right, you think retirement is going to be the greatest thing that ever happened. You get home and you go, whew, I've done all my honeydew jobs. I've cleaned out my closet. I've cleaned out my garage. I've planted all my flowers. I'm bored. I want to go back to work. Well, this is a mulligan. You say, all right, yes, I claimed my benefits, it's within that first year, but Social Security, I'm going to pay you back. I'm going to pay you back my benefits. If my spouse was taking benefits, I'm going to pay them back as well. And it's like an interest-free loan for whatever period of time that was. But you have to pay them back. And you have to do it within the first year. There's the form, and there's how you would apply. And some people will say, ooh, well, I didn't make it during that first year, but now I really would like to make a different decision. This is the start, stop, and restart. This is voluntary suspension. Well, once you started it, 62, and let's say your full retirement age is 66, you can't stop it until you get to your full retirement age. But then you can suspend your benefits and you can restart any time between that full retirement age of 66 or 66 and some months to 67, all the way up to 70. So hypothetically, you could still get that 32% growth, that bonus period, off of that amount that you stopped. So that's that start early, stop at full retirement, and restart your benefits somewhere between full retirement and 70. So, will I outlive my money? Well, again, how do we make these determinations? The first thing you need to do is determine what are your income needs. A handout that we gave you besides the course evaluation has a budget worksheet. And I would recommend, now some of you may have a different format, you may do this online in an Excel spreadsheet, but for many people, hey, give me somewhere to start. Show me different categories of what I might be spending my money on now and what I might be spending my money on retirement. So it's right here for you to take home. So, what are your current income needs? Well, what are your expenses? That's going to tell us a lot. And what do you think will change? So on the back of the sheet, there's a couple of things that ask you about, well, do you expect something to be paid off, like a car, like a house, some of these things? What is going to change for you? And then how do we integrate what the budget you're going to need is with the back of this sheet? And if there's a gap, well, this is what I'm going to have coming in. This is how much money's going out. Uh-oh, I got a gap in there. How are we going to fill that gap? Well, that's where we really figure out what you might have in other sources. So what do you have in a 401k, a 403b, in your Roth IRA? Some of these types of retirement accounts. So what's the beauty of that? And boy, we tell everybody, if your employer offers a match in your retirement program, at least contribute however many percent that might be, because that's 100% return on your money. If you put in 3%, the employer will match 3%, that's 100% return before we even have investment experience. You have some control because you can choose what types of investments within the plan you want to participate in. And of course, if it's that pre-tax, you're not paying income tax on it as it goes into the plan. In the Roth, you are contributing after-tax money. Now, what's the cons? Well, how many of you enjoyed opening up your December 31st statements? Weren't much fun at all. Now, I'm sure you've gotten your first quarter statements, you're going, oh, this is more like it. What this is saying is loss due to market risk. Again, we're going to see volatility in the markets, and that's normal and natural. The problem is when you're in accumulation, it's not so painful because you have time and you're still accumulating. When you're in retirement, you're now in preservation and distribution, and that market risk can be painful if not planned well for. Also, remember, Uncle Sam is your partner in any pre-tax account, not in your Roth, but your pre-tax account, and you have the risk of investment decisions and income distributions. Back to how much am I going to take out? When am I going to take that out? So there are probably a few of you that have defined benefit pension plans. They're fully funded by the employer, relatively simple because the employer's doing it. Benefit is unknown. Part of the problem is there's only one plan, and you don't get any say in the investments, and most don't have that cost of living increase. It is fully taxable. So then we have to look to your investments. Remember I said none of these are going to stand alone. It's like a three-legged stool. Without Social Security, stool's not very stable. Without those pre-tax or Roth investments, not very stable. Without your after-tax investments. Now there may be dividends, interest income from stocks, bonds, mutual funds, and CDs. You can maintain control over your account. There may be some tax advantages like long-term capital gains versus ordinary income. You may pay taxes on earnings only. But remember, you still have to pay the taxes. There's still market risk. There's still reinvestment. What if you have a CD that matures and rates have gone down? Maybe they've gone up. There's no principal guarantee when you're in the market, and you again are responsible for those decisions. So what about annuities? There are all kinds of annuities, and remember, you want to look at what was the purpose of the money. If I'm trying to find some guaranteed income, maybe that immediate annuity, one that between age 66 and 70, 71, because most it's a 5-year, you say I want to fill up that gap so I can delay my Social Security. You might use an immediate annuity. You might get something that has a fixed rate, which would be better than a CD. You might get an indexed to a market but not in the market, or you might get one that's subject to the market. So you maintain control. If it's non-qualified, it's tax deferred, and there is some potential with benefits for a guaranteed growth rate and an income level. So maybe that's the answer, but it does take a long-term commitment. Now, one people often don't think of is permanent life insurance. If you happen to have a whole life policy, I have a number of people that come to class that say, my parents took out a policy on me when I was 5, and I've just kept it. And some of you may have had whole life policies as your children were growing up, or an indexed universal life, or term insurance. There are several opportunities that you might find with some permanent insurance coverage. You control the account, you can take loans, you can take withdrawals up to cost basis, and you can actually do early access before age 59 and a half. If you don't use it while you're alive, you can leverage that death benefit. And today there are a lot of hybrid products out there that might be a combination of life and long-term care, something new in insurances. So it takes time and it takes planning. The key to all of this is to begin now. Everybody says, well, I wish I'd done this when I was 25 years old. There's a couple of 25-year-olds. Do it now. But for the rest of us, we have today and going forward. So let's figure out what that comfortable retirement might be. Again, if you've enjoyed this material, please give us your feedback on the evaluation and the grading of that. If you would like that individual strategy session and to secure a Social Security report based upon your numbers or your and your spouse's numbers, we are more than happy as the American Financial Education Association to help you. Again, remember our mission. We want you to be able to take control of your finances and to enjoy your retirement. So we thank you on behalf of AFEA. We hope you've enjoyed this. If you have friends that missed this class, we do have 2 upcoming classes at King University and Blount County Library. Feel free to invite them. We have some invitations. We would like to thank AFEA for inviting us. We hope that you have enjoyed the program and that people that weren't with us today can catch us on video and watch this Social Security information. Thank you for your time and your attendance. Folks will be in the hallway.